No other red bar from all the way back to the 1970s gets close to this line. This is a record monthly drainage of physical gold from the COMEX. There's a long way to go. There's still a lot left. First, I wanted to say a few words about the CPI, the Consumer Price Index. Everyone is talking about how it didn't move at all last month, and inflation is now transitory. We've been through the transition. We're transiting, and it's very exciting for all the status people. But no, that's not what's happening. Two things. First of all, we have the food at home prices. This is the most basic of basic necessities because you're too poor to go out and eat out. So you eat at home and you buy food to survive. The percent change of food at home, according to this Fred chart going back to, let's see, 1950 something, right? Go back, zoom for a year. We can see that every month sequentially since January of 2022, this index has been going up over 1% from month to month since January. So that's 8 months. This is the most consistent amount of time that we've seen month to month increases in food at home prices. People are getting poorer. They can only afford food at home. They cannot afford other things, and therefore the prices of other things are dropping slightly. For example, if you can't afford a vacation, you're not going to drive across the country, and your demand for energy, for gasoline, will go down, and that will help subdue prices of gasoline. But not food, because you still need to eat. You can see that we are now at a whopping 13.1% year-over-year change in food at home. That is the highest since 1979 when we were at 14.28%, and we're going to break it in the next few months. Next, if you look at the Atlanta Fed's sticky price inflation gauge, this divides sticky versus flexible inflation. And look what is climbing. We have sticky price in the orange, where it says sticky price 12-month, 5.2% in May, 5.6% in June, 5.8% in July. And the biggest component of the sticky price, which means prices that do not change as often, the biggest component is owner's equivalent rent. Owner's equivalent rent, that's the made up number they have for rent prices. And since it's the biggest part of the sticky CPI and the biggest part of the CPI in general, you can see that it is going nearly vertical since March, April. We are now up to 5.48%, 5.83% in July, highest since 1990. This silver report is brought to you by Fortuna Silver Mines, which just released their earnings yesterday, August 10th. And President Jorge Ganoza said the following: our business generated healthy cash flow of $21.9 million in spite of declining metals prices in the quarter and the compounding negative price adjustments this triggers on our concentrate sales. Well, compounding negative price adjustments because of falling silver also means compounding positive price adjustments when silver rises back up. Now, their all-in sustaining costs and cash costs are below the cost spot, and so they are still profitable despite the huge declines in prices of gold and silver. The company is safe. It is still making money in these negative conditions, which is exactly what you want to see in a mid-tier miner like Fortuna. Made some boxy charts here. First, to illustrate a basic point, we all tend to see it as impossible that the COMEX can ever be drained of all physical gold and silver. It seems like a Herculean, monumental, impossible task. However, there were 2 points in recent history, as recent as 2019, when the registered supply of gold at the COMEX was functionally zero. These just happened to be at lows in the price, and when interest in the precious metals markets were at lows and nobody cared, which is why the supply was at zero. Those were here in 2019 when you see this dark gray line at zero over here. This was one of the final plateaus in gold before it broke a 6-year trading range from 2011. And before that, we had the lull of 2018, late 2018, when registered supplies were zero for almost 3 to 4 months, it looked like, for a very long time. And then we see what happened in 2020 with this rectangle. There were record deliveries, but they were flowing into New York, mostly from Switzerland, not from London. So the myth that bullion banks are short gold in New York and long gold in London is a myth. It is not true. Even if it is true on paper, the gold does not come from London. If it has to be delivered, it comes from Switzerland, and that's what we saw in 2020. So here we see during the lockdown era, which was here, that tiny dip in March, the crash of everything. And we see both the registered and the eligible supply rocketing up an insane amount, a record amount. And finally, over here, this final rectangle, we are seeing both the registered and the eligible supply finally start to move down. We're going to see how fast in the next slide. Here's a chart I configured. First of all, two things about this. This is very long term. You can see what was happening during the 1978 to 1980 gold and silver panics, when the currency was on the brink of true and total endgame collapse. And we saw here the supply of physical gold in this little gray over here. It started to skyrocket back in 1975, 1976. And during the actual spot price panic, when it rocketed about 5 times in gold, the supply at the COMEX didn't really do much, which was telling you that the center of the market was not really at COMEX at all. It was in the bullion coin dealer shops, where the price actually hit $50 and above for silver. At COMEX, things were relatively quiet. It's hard to say really that what was going on over there in New York was really responsible for what was happening in the retail markets, at least not directly. It's very difficult to figure out what exactly was going on back then, aside from just a public panic over the value of the dollar. Paul Volcker was able to save the situation by raising interest rates 20% and more, a solution which is entirely impossible now on any grounds. Here you see this double line I made, red and black, just to give it some emphasis and highlight. I made that line right at the monthly bar here. This is the monthly drain figure, putting right at the end of this bar, a tiny little bar over here, and you see that it exceeds in value any other bar. No other red bar from all the way back to the 1970s gets close to this line. This is a record monthly drainage of physical gold from the COMEX. There's a long way to go. There's still a lot left, but a little less than 30 million. We have 29,757,000 ounces here, but it is draining fast. And now, here, I want to show you the history of deliveries since 2017 in gold. This is a very interesting chart because here we see the proportion of delivery ounces over the amount of physical gold available at the COMEX. And here we see in 2018 a spike to about 300%, which means there was 3 times more deliveries than there were physical gold. How is that possible? Is this a conspiracy? Is there something going on? Is there foul play? The answer is simply no. It doesn't look like it from here. What was happening is that gold was going into the COMEX and not out. 3 times as more gold went in, and you see this little bump here. That was deliveries into the commodity exchange. Same thing happened here in 2019. Spike in deliveries over here, 250% more supply went into than was available. That was because deliveries were going in from just above zero in the registered supply. And we saw the same thing in 2020. Huge amounts of deliveries, this time all of it going into the COMEX. The absolute number of deliveries back here in 2018, when the ratio of deliveries into the COMEX was 300% more than was actually there, that was still a small amount of deliveries. They were all going into the stockpiles. And here, all of that stuff was going to the stockpiles, and it all came from Switzerland. And now we see between this rectangle and this rectangle still elevated deliveries, but none of the metal was actually moving anywhere. This was just warrants being shuffled. But now we are seeing a similar amount of absolute warrant deliveries, but the metal is starting to move out, and it is not moving into London. How do I know it's not moving into London? Because of this chart. We see here the total amount of metal, of gold in the LBMA has been static since late 2020. It hasn't moved much at all. It's still about 9,600 tons or so. And since it has not moved, we know that the gold that's flowing out of the COMEX is not flowing into London. Where is it going? I believe it is going into private collections, or is being used to supply the coin dealers. And I wanted to take a little trip back into March 1980, after the initial silver crash, post January 21st, 1980. This was at the point when people realized that Volcker had actually saved the dollar by putting interest rates at prohibitive rates of about 20%. From an economic standpoint, this is the Washington Post, March 28th, 1980. One of the last inflationary bubbles has been burst, said Michael Metz, vice president of Oppenheimer and Company, and a respected market analyst. All of the speculative fluff is out of the stock market, added Metz. Next comes real estate. Calling the collapse of the silver speculation profoundly disinflationary. He said almost every speculative game in town has proven fatal of late. Maybe people will go back to old-fashioned savings accounts, which would be a tonic for the economy. At that point, it made sense for people to go back to savings accounts because they could earn 20% on their deposits, which made sense to do. Why would you hold silver if you can earn 20% on your deposits and the inflation rate is falling? It looks like if you can lock in that rate at that point, which you could if you got a savings account, that your savings would only increase. So there's no need to speculate on metals or any other security, whether it be stocks or anything. You can just have a savings account and you would know that your purchasing power would increase, which calms down the economy, which calms down the gold and silver prices, especially the silver prices. There's no need for panic, and that is what was happening. Bullet point 4, lessons learned from the silver market, other economists said, could cool the speculative fever in the economy that has fueled the fires of inflation. Speculation based on the premise that inflation will continue indefinitely has drained away investments that otherwise would have built homes and factories that contribute to economic growth. This last point is actually pretty important. When people believe that inflation or consumer price increases will keep going and going and going higher and higher and higher, there is no investment. There's only a scramble to preserve existing purchasing power, which is why things don't get built, production stops, the supply, everything goes down even further, and prices keep going up and up and up. This is what happens in a hyperinflationary economy as the chase for a preservation of value goes into a fever pitch, which is why gold and silver are the ones that go up the fastest during that time period. And now, my question to you is, do you believe that there will be any point in the current monetary system where people will be able to earn enough interest without the economy collapsing on a savings account in order to deaden down speculation, whatever assets, be it stocks or real estate, or especially gold and silver? No. Interest rates, real interest rates, will not get that high because the Fed is chasing, and there's no way they can catch up this time. All that is needed is one little hint of recognition that there is no way the Fed can successfully chase the consumer price inflation rate. And that could easily be triggered in the next 2 to 3 CPI reports.